you're starting up a business, part of the goal is just getting things going, getting your product out there, your idea into the real world. And sometimes accounting can be an afterthought, but that afterthought quickly can become a roadblock.
Crypto and digital assets is a language all its own. And so is accounting. Accounting is a language, set of standards, and best practices that is developed and evolved to serve the needs of business leaders, investors, and regulators over hundreds of years. With the advent of Bitcoin's triple entry accounting, the stage is set for a paradigm shift in the way we interact, transact, and store value. However, businesses with crypto at their core, or even those that interact with crypto as a payment solution, still have a double entry requirement. Your crypto VCs still want double entry books. M&A deal process still requires traditional financial statements that accurately reflect the performance of your business. And tax authorities globally have record-keeping requirements that demand it. So how can startup crypto businesses, or one starting to interface with crypto, ensure they are reflecting their triple entry activities in the two-dimensional framework of GAAP or IFRS? Today, we break it all down with a deep dive session tailored for the technical founder audience. What can you take away? An understanding of accounting basics, avoiding pitfalls, and knowing when to bring an expert in to help. Welcome to TNF Takes, the go-to spot for crypto companies and on-chain organizations. Before we dive in, if you like this content, make sure to like and subscribe to get more top-tier content for your crypto company or on-chain organization from industry experts who have been around the block. I'm Noah Buxton, and I'm here with Nick Ward from the network firm. We're here to help you establish trust, build efficient crypto operations, and stay ahead of the curve in an ever-evolving industry. Welcome, Nick.
What's up, Noah? Good morning.
Good morning. So I wanted to set this time for discussion to kind of hit the high points and maybe go just a little bit deeper, right, on, startup accounting for crypto companies, whether, again, crypto's at the core of the business or it's sort of the business is sort of tangentially starting to interact in crypto for payments or through a partnership, through a product use. There's a lot of ways that crypto is starting to seep into other technical businesses, software businesses. So I think this will be the start to a larger series. I'd like to really do probably a 3-part series where we go very deep and almost like really ed session where people can actually directly take away the advice and actually implement and do certain things on their own. I think we get to a little bit of that today, but I'm looking forward to discussing about all this with you.
Yeah, likewise. Now, I think this will be a good one. And, as we know, when you're starting up a business, part of the goal is just getting things going, getting your product out there, your idea into the real world. And sometimes accounting can be an afterthought, but that afterthought quickly can become a roadblock. So we want to try and give a good context to avoid that, right? So this will be a good one.
I love that you said "as we know," and I think that's really interesting actually because the network firm is actually a startup business as well, right? We're 2 years in business now, and I think we're doing great. We're growing, but we've actually had some of the challenges that our clients have, and we've had to actually do this. And I think that's actually really interesting, right? Because a lot of CPAs, a lot of accounting folks, even consultants, haven't actually run their own business, haven't actually dealt with these challenges on a daily basis. And so a bit of it stays theoretical to them, whereas it's very well known to us.
Yep, for sure. Yeah, they know what the output needs to be, but if you haven't been in the weeds, it's hard to empathize with, how did you get to this point and not have records, right? But
Exactly.
yeah.
Yeah, I hope our clients feel that. I think they do, right? That we bring that level of experience and, like you said, sort of sympathizing with all the details. Yeah, I think, first I wanted to dive into sort of some foundational accounting topics for crypto startups, essentially like why these financial basics matter. What are the main components of a finance and accounting function, some alpha tips, hopefully. And then, sort of thinking about what is the cost of good management accounting and financial reporting. So let's dig into that first. What do you think? If you had to explain it in a nutshell to a technical co-founder who might be of the perspective, hey, like all I need to do is move fast, break things, build product. I can figure out the numbers and the accounting later.
Yeah, in a traditional sense, when you had one bank account and everything was running out of there, maybe, even then I think there's some classification to where things go in your books from how you're spending, right, and where revenue is being received. That's going to matter. But that's not the world we're in anymore, right? They likely have a bank account, yes, but then they've got crypto wallets they're using to execute either just testing their product or executing payments and receiving payments. And so the thought of getting 6 months, a year and a half down the road before even considering these books is going to be a big mess to clean up. And it's going to take time away from, again, driving the company forward.
Yeah. That's a good point. And I would tell you from practice too, if you're of that mindset, we do a lot of cleanup accounting. So, the outsourced accounting practice, a lot of times the first interaction is actually, okay, let's actually clean up everything that was done wrong or that wasn't done. And it happens. It's fine. That's our job. But I can tell you that the cost of those projects quickly becomes sort of the present value of what you should have done, basically, and sometimes with a premium, right? So it's not as if you're actually saving costs, because if the business is successful, you're almost always going to reach a point where you need what? You need a financial statement audit, or you need to actually share gap financials for a fundraising process, or hey, you're ready for an exit. Guess what? That deal M&A needs financials. And so then, you have a very important phase of the business that's now going to get tangled up because you have to go backwards in time, restate financials, build financials, the whole thing. So I think we'll come
Yeah, no,
back to that theme a little bit, but that's one
yeah,
of the ones.
it'll be revisited a few times here, because then it's also, to your point, like on the M&A side, it's, hey, you might have an idea for what your valuation is or what the picture of the company is based on just your cash flows and your ability to get where you got. But when you take the time to really set those financials up, that picture may not be as pretty as you thought, or the buyer thought. So you don't want to have that surprise when you've got a deal you're excited about in front of you.
Yep. Now let's talk about the sort of the main components of the finance function. Let's put the elements on the table, and then we're going to refer to these things probably as we go. So I'll lay those out. I think, if you had to bucket it in three areas or three buckets, you've got sort of bookkeeping, you've got compliance, and you've got planning. I think that's one fair way to put it. Bookkeeping, right, is the basic transaction tracking, which becomes not so basic when you have significant crypto activity and new tools are required, new processes required. You've got, I have four buckets. So bookkeeping, reporting, compliance, and then planning. So onto the second one, reporting. This is like your financial statements, right? So you can do a bookkeeping and accounting process, but the process of producing financial statements sometimes is a click of a button, but oftentimes it's not, right? Oftentimes there's some process that's required to go from journal entries to actual financial statements that you can present. Then there's the compliance aspect. And I think that's back to the top. One of the other reasons why this matters is there's so many little pitfalls. There's so many changes in tax law. There's a lot of risk for the business if this stuff isn't properly tracked and managed. And then to planning, this is budgeting for growth. This is having a forecast. This is knowing where you're going, ability to control costs. And so this is a very important area too, that in startup land, we don't often see, a lot of detail around. So.
Yep. No, I think those buckets are key.
So let's get to some alpha tips for technical founders. Again, you're not in the accounting weeds every day. You don't speak this language necessarily. What kind of quick tips can we give before we get into some of these other topics and potential pitfall areas?
Yeah, I think one good one, you start with bookkeeping, right? Because most of what your bucket you lay out, reporting, compliance, and the planning after those is going to build off of that. If you don't have any records or good solid books to look at for those things, it's going to be really hard to get there. So some of the tips would include looking for the software solutions to help automate some of it, right? Your standard accounting software like a QuickBooks Online will allow you to at least plug into your bank account. You could start to tag transactions, so some of that stuff gets automated. On the crypto side, there are crypto softwares that can help as well. Again, it's going to be setting the time aside to go ahead and vet those, find one that's right for you, and similar to the QuickBooks with your bank account, start to tag wallets where you can, where hey, I pay my contractors out of this wallet, so I can tag their addresses and it can start to automate the flow.
That's really good. That last one, sort of the wallet hygiene. We talk about this in so many respects, even from like the proof of reserves side of the business in terms of wallet hygiene, managing customer custodial assets, all the way through to the tax aspect, which there's some changes in tax law that we discussed last week about this, and hygiene helps. And then to the accounting, and which then comes to like the presentation on the balance sheet. wallet hygiene cuts across a lot of areas. So that's definitely some alpha. Think about how you're receiving revenue, how you're spending out of wallets for expenses. If you've got wallets that are involved in a protocol, right? Think about that as well. Like, how are you structuring the revenue, expenses that fund smart contract gas, things like that? Some organization there goes a long way. And my
Yeah,
alpha, go ahead.
no, go ahead, Rip.
I was going to say two quick alpha things I wrote down. It's kind of funny actually, because I wrote down like, use software that integrates with your wallets from day one. And I also wrote down avoid relying on spreadsheets. And now that I'm thinking about it, it's like, yes, that's true, but also completely the opposite. Be totally open to the idea that the crypto software is not going to work for you on day one. It might not fully support your activity. Also, be prepared for if you do select a software early, you're going to pay potentially an integration fee. There's going to be a ramp. There's going to be a ramp in process to that. And actually with other good tracking, especially if you've got technical folks and developers in the business that can produce information for you, that actually there's ways to get around needing a software on day one. Eventually you probably will. It probably makes a lot of sense. And then also, yeah, maybe you want to automate things, but do keep spreadsheets, because when you come to us for a cleanup, the more historical records you have, even if they're not perfect and even if they're a bit disorganized, having something, to go back in time, having some breadcrumbs, right, to follow is really helpful. So,
Yeah. Yeah, it does go back to there is that opportunity there to have multiple wallets that have kind of a dedicated point to them, right? Again, this is my payroll wallet, this is my revenue wallet. And it's an extra step. It feels like now I have to manage something else. But to your point, managing a list of wallets in a spreadsheet that you know what they do for, and then you actually subscribe to that and are disciplined about it, will make your life a lot easier and may reduce the need for an automated software, at least at the beginning, when there's not too many transactions to manage, and instead you're just managing a couple different wallets. So that is something I've talked to founders about if we get to them early enough, and it's generally worked out well in terms of reducing that that mandatory or manual time to just be tracking transactions a few times a month.
right. Yeah, I mean, it actually makes perfect sense if you think about a traditional analogy too. Like, imagine, I was advising you and I said, hey, with your payroll, you're actually going to need to connect 10 different bank accounts, and you're going to need to sort of pay those use those in a haphazard fashion. And then, in terms of accepting revenue and payments from your clients, it's going to be with 4 different bank accounts. I mean, that would be absurd, right? People would say, no, like just one bank account for each, or the same bank account for both, frankly. So yeah, wallet hygiene is important. And we know there's chain concerns, there's EVM and not EVM and all of that. But to the extent that you can organize, it goes a long way.
Yeah, for sure.
So the other thing I think I wanted to share, today was just give people an insight to sort of the costs of good management accounting. Because I think this is a pretty, throwing a dart at this and trying to be accurate for most people is really hard. They have no idea when they're coming in what this takes. And so there's a few ways to frame this, like, well, what would be the cost of building your own accounting function? And if you did that, like, sort of what level do you need to hire at? And what are the standard salaries? We can talk a little bit about that. When do you need a CFO? So let's sort of narrow in on that a little bit. What do you think in terms of the costs of good management accounting and financial reporting?
Yeah, part of that equation is how much is happening at the onset, right? If you have this larger R&D phase where you're still kind of ideating on a product or refining it to bring it out, you may be able to get away with just yourselves and a good spreadsheet, or again, maybe 1 or 2 tools. But let's consider that you're kind of ready to launch and you do have some decent transactions. I mean, I think the cost of a part-time bookkeeper is going to be something that's worthwhile at the very least, because again, you as founders are going to get more real-time information. It's not time you have to take away from the business. So I do think that's an earlier cost that should be considered even before you're ready for that compliance real planning bucket. But I think that's kind of step 1.
Yeah, I like that. I like thinking about that R&D sort of phase where, yeah, you can probably get away with pretty simple bookkeeping. Obviously, if you're a technical founder of a crypto business, you're a pretty smart person, so you can probably figure out QuickBooks. Even then, I would still recommend a simple bookkeeper, right? And we do that. We support clients like all different levels, right? From, hey, we're just going to do some journal entries for you. We're going to reconcile your Brex, card, your expenses and your bank account, and very simple stuff. All the way to, hey, we're sort of your full accounting office. There's 5 people on the account. You sort of have CFO level advisory as well. But yeah, on that lower end, I think that's worth the spend. That can be $1,500 to $2,500 a month to just do the expense stuff, to ensure the payroll is run accurately, to ensure expense reimbursements and bank reconciliations are done. And you just have simple books, right? Are you going to have perfect financial reporting? Again, those might be 2 different things, right? No, but I think that's money well spent there.
And usually those outsourced teams, like I know our team, right, they can scale with the business before before our costs start to really increase, because we're automated, right? We've got teams that do this every day. We can scale with you to a level where our prices, may eventually tick up with transactions, but not to the level of a full-time salary, right? Where you're getting into, 55 to 60 grand, maybe at a minimum of a full-time hire with benefits and everything like that. So that outsourced team can be a huge lever for you to pull and keep you going for those first couple of years.
Exactly. That's exactly right. Yeah, that's the other measure, is sort of weighing, okay, what's the cost of just getting a little bit of that outside expert help outsourced versus bringing someone into the team. I mean, most folks, candidly, technical co-founders aren't ready to build a finance and accounting function within the business. And even if they did, like, that becomes it becomes very expensive very quickly, right? You've got sort of the salary, benefits, fringe benefits for, let's say, a controller, right? Because I've seen folks that will go and hire like a bookkeeper. Oh, they've done books before, or, I knew them through someone, they've done QuickBooks before. They don't end up doing what you actually need, and they can't actually do everything. So there's still an outsourced requirement. Then you've got folks that probably do the right thing, get more of like a controller level resource. They might still not have enough capacity to do all of the accounting activities, but you're still there. You're talking, between, what is it? It depends on where you live, right? But we're talking about 90 to 130K a year, right? Just on a single person, and you still might need outside tax and accounting help.
For sure. Yeah. And that role, like from the founder's perspective, right? That role's not driving revenue. It's something you need, but it's not driving revenue. So early on, that's usually the juggling act the founders are playing, is we need to drive revenue. We need to make this thing real. So to take on 90, 100, $110,000 salary is not something they may have the stomach for. And we get it, right? We understand that.
Awesome. So let's move on to sort of tax compliance essentials. I think that I want to hit this pretty quick because we've done some tax talks that I think folks should look up. We've got some blogs on the site that I think are helpful. We're always here to answer questions if you have them. But I think this is one of these potential big pitfall areas. If you're not doing proper bookkeeping and reporting, yeah, you're probably going to have trouble at tax time. So here again, it's like you think you're saving money and time, then it comes tax time. You're paying for that anyway. You're paying in opportunity costs of your time to now rush and get this done. You're paying in stress and inability to sleep, and then you're paying out of pocket too for the outside help. So I wanted to cover sort of some crypto specific tax obligations real quick, maybe some quick actions for founders. I put 409A valuations down just because I think that's one of multiple things that kind of, doesn't get a lot of discussion, but is very important. So yeah, let's pick out a couple crypto specific tax things.
Okay. Yeah, let's start with the very basics, which may or may not be known, right? But with crypto, when you're receiving it, it's income, the same as when you're getting paid in dollars. But now you've got in the IRS's eyes, a capital asset or a piece of property, virtual property, that when you spend it or liquidate it for any type of fiat, you have another taxable event. And so to your point, that's where a lot of founders, they're running the business, they're managing their cash flow and crypto conversions, but they're not realizing that I've created a taxable event each time, and now I've got this surprise bill that I didn't budget for come April or end of the year with estimates due. So that's kind of the starting point of why you'd want to be tracking this, so that you can anticipate that tax bill when it comes.
Absolutely. Yeah, another one I see here is, it's actually kind of just business basics or tax basics as opposed to crypto, but people don't often think about it. Is we're used to thinking about crypto taxes in the individual sense, income events like you sort of described, and also capital gain and loss events. And those can be true in a business, right? If it's taxed as a partnership. So if it's an actual partnership entity, if it's an LLC, default treated as a partnership and hasn't made a corporate election or to be taxed as a C Corp, right? So if it's a LLC with a C Corp election or it's a formal C Corp, an Inc., then there is no capital gain or loss aspect. And so, yeah, you want to know if your tax is a partnership, you definitely want to know that, because the tax obligations and the reporting are vastly different for you as a partner in that business, and also investors that are.
Yeah, I'll call out on the SAFs. Even from the side of the buyer, it can be interesting because you may participate in a SAF. You buy 30 grand of this future token, but then the devil's in the details. Your accounting team knows you spent 30 grand. They may just record it as such, and they may even take that as the general cost basis for these tokens when they come in. But we've come across it many times on the audit side, where when you get that SAFT agreement and you get into the details, you'll see something like, hey, the price per token you're actually going to get it at, if there was maybe, like, if it was open to the market before your vesting period is over, is the lower of the price of the token when we gave you this agreement, or that fair market value. So again, those details that when you're running the company, maybe you bought them to participate in some liquidity pool you want to test out, or some, a DeFi protocol that's coming, but you've now a year down the road when you're actually getting the tokens and you don't revisit the agreement. Come that audit time, they're going to realize, oh, your cost basis is a little different when you actually looked at the details and noticed that maybe this was open to the market before you vested. So again, it's a really good one, and it's one that you have to kind of continually pay attention for, really vet, and have some notes, for your accounting team or yourselves to remember to go back and check, all right, what is the actual terms, and that will flow into what my value is of that liability or token receivable or token asset once it gets on the books.
Yeah, awesome. Good insights. So, crypto on the balance sheet, right? So the balance sheet, right, being one of the key financial statements in a business, the profit and loss statement, statement of cash flows, and the balance sheet. And so the balance sheet really, records the sort of financial position, of a company at a point in time, right? End of a 30-day period, end of a year. What are the assets? What are the liabilities? What are the shareholders' equity? So how do crypto assets present on the balance sheet? This is actually a rabbit hole, something we've worked on over the years. Like, we helped with fair value accounting moves that were made by FASB, Financial Accounting Standards Board, who actually set GAAP in the US. They set those GAAP standards. And so that was pretty hard fought. And we end up with fair value accounting for certain crypto assets. And it's good. I think there's still more to be done. So this one, I think we could go for a long time. So let's try and put it in a nutshell for folks. On the one hand, certain crypto assets can now be marked at fair value on the balance sheet, periodically. And this is good ultimately because your balance sheet can now more accurately reflect the economic reality of the business at a point in time. If you want to learn more about this, look into MicroStrategy, and the arguments they made around this. It's a pretty clear example, right, of a significant Bitcoin holding where they had to hold it at cost on the balance sheet. And market value was significantly higher per coin than cost. And so they were saying, hey, look, we're not able to mark this up, right? If anything, we're only allowed to impair it under this current standard, and we'll never be able to mark it back up if we've impaired it or reduced the value of it. So this balance sheet doesn't reflect the economic reality of the assets that we hold, and they are liquid assets. And so that has changed now, and companies can use fair value accounting, but only for certain things. And so I think this is an area where, again, it's fact dependent. Some of these things require a bit of a accounting analysis, a technical accounting analysis up against GAAP or IFRS, the international equivalent. What about things like stable coins? Are those cash and cash equivalents? There's a lot of questions that come up here for accurate presentation and accounting. So yeah, I don't know if you have anything to add to that, Nick. In this way, go ahead.
Well, I'll call out, and I might be a few days before we get this episode actually posted, but 12/15 is the effective date for that FASB, right? People could have early adopted, but as of today, all financials issued after 12/15/24 have to adopt it. So I think it's relevant. I don't know if that was on your mind or not, but yeah, obviously that's something that's exciting for the industry, because we feel strongly, and I think most of the industry agrees, that, hey, that didn't make any sense. We need to get to fair value. To your point, though, then drilling down into stable coins being cash equivalents, I think everyone in the industry feels that way, but unfortunately, the accounting bodies have not defined it as such, and stable coins are separate. So you will need a separate bucket. Now, I would say what you can do is say, all right, I can have a stable coin line item on my balance sheet because I know that bucket of assets, their value is pegged to the dollar. So that's going to be a simple tracking of here's the stable coins, they're at a dollar. From there, then you have your other buckets of, if you have Bitcoin or Ethereum, for example, you can have that digital asset. You'll want to track the cost basis of those because as you're marking it up, there will be that other account of, unrealized gain or loss, depending on which way the value went. And then as we talked about earlier with taxes, that all still comes into play of what is my cost basis versus the actual fair value when I liquidate or spend those coins. So as far as the balance sheet goes, yeah, you can have those different buckets. You will want to look at that FASB because it didn't include all assets like NFTs, for example, still have to be at cost in that old treatment. And, they get impaired if they go down, but they don't go back up. So there is now still that nuance. It's not an across the board application.
Yeah, that's amazing. Good. Yeah. Thank you for all of that. And also happy fair value accounting day, I guess.
Yeah.
It wasn't, yeah, that date snuck up on me. I didn't realize it was today, but that's kind of a funny timing. So yeah, that was very, very good context. I think what you were speaking to was GAAP, right? So if US business, probably following GAAP, some offshore, some BVI, some Cayman electively following GAAP. But there's a lot of crypto businesses that are going to be an offshore BVI or Cayman entity that are going to follow IFRS electively, and other jurisdictions that'll follow Japanese IFRS, other jurisdictional specific IFRS. And so that's a little different. They've been essentially ahead on fair value accounting in some ways for crypto assets, but it manifests differently on the financials through other comprehensive income or OCI, as opposed to what you mentioned, right? Realized gain loss through the P&L, the way we say it, through the P&L versus OCI for IFRS. So that's accounting wonky stuff, but I guess if you're technical co-founder and all of that was like, what the heck are these guys talking about? It is important. As Nick mentioned, there's this financial statements after 12/15/24 need to use this fair value accounting under GAAP. And so another reason, hey, reach out, let us help, even if it's a quick conversation to clarify this, to look at your trial balance and tell you how things are going to change. I'm going to hit one quick thing on debt management. Like I've seen this come up quite a bit on bad debt. I don't think folks are necessarily doing the right accounting and tracking of accounts receivable. And some crypto startups don't even have revenue. If you're pre-revenue, you sort of forget about this. But once you do, you might have AR, right? It starts to age 30 days out, 60 days, 90 and 120. And the proper tracking of this is that eventually, right, you create a policy to write down what we call bad debt. Bad debt becomes an expense on the profit and loss, and it reduces taxable income. So this is an area you don't want to just be carrying bad debt period over period when you could have a very direct tax benefit at the end of a year by writing this stuff down. So kind of hurts to write off AR, but at the same time, you're getting the expense benefit, and it's a deductible expense for tax purposes. Partners, including K1 reporting and all of that mess, basically, that you'll see at your end. So yeah, I think the quick action points too, like definitely, understanding your tax landscape is a quick action, right? And frankly, you can do some of that on ChatGPT or other AI tools. You can get a basic sense, right? You can talk to folks like us and we can quickly narrow in on what you need to be doing. But yeah, definitely think about that tax landscape because it's going to matter to your financial accounting process, right? The things you do to compile transactions, track everything, you're going to want to know the taxability of those events, not just at the year end, but throughout.
Yeah, and maybe this will be a recurring theme throughout, but grabbing, your wallet history, your exchange history, having that as support, because when you're filing taxes, whether a business or individual, the burden is on the taxpayer of proof. So obviously you don't ship everything off when you file your taxes, but in the event that an audit could happen, you're going to be expected to pull all that. So again, thinking of the future early and just having all that stuff prepared. If something happens, you've now saved some time, at least you're ready to, hand off to some help if that happens and you've got records pulled and you're not having to go and dig them back up or try to find them after the fact.
Nice. Okay, last thing on tax stuff real quick. 409A, IRS, we love just use numbers, right? But 409A valuations. You want to give a quick definition of what these are, or you want me to?
You could handle this one. Yeah, I think you've been a little closer.
Yeah. Essentially, a 409A is a type of valuation, right? So there's a bunch of things that can be valued across business for tax purposes or accounting purposes, where expert help or certain methodologies needed to value something. Could be an asset, right? Could be your intellectual property. It could be your goodwill. Could be, specific real property, right, that the business holds. So an A is related to the value of the company, or the value of the shares in the company. And this is one that I see kind of misunderstood. It's important. Like, here again, we had to do this as TNF, right? We're an employee-owned business, and NA valuations for our shareholders and option holders is very important. We compensate people in stock options. And when you do that, you have an accounting and tax impact, right? You have to record those on your financials in terms of, it's an expense, right? And so, but then how do you mark that expense? Well, you do that through the valuation or the value that comes out of your 409A. And so there's an accounting aspect to that, right? Accurately reflecting the economic impact of granting options on the business, from the business, but also the tax aspect, right? Because these become a deductible expense. And so, knowing the valuation of these as they sit on the books, and also for tax purposes, pretty important. And there's IRS penalties that can definitely come from improper valuation. So the quick tips here are: think about this if you've got equity holders in the business, or you're creating an options program to incentivize talent. This is pretty important. And it kind of gets onto an annual cadence where you can run on your valuation from a raise, let's say, for a year or so, but then you kind of need to get into this repeatable cadence of getting a 409A done. And these are, between probably 4 to 8,000, depending on sort of the size of the business. And you need to get these done annually. All right. We're a ways in here. I think a couple more sections. Let's just go through a few financial challenges, maybe things we've seen in the field or best practices. So I wanted to touch over controlling access to funds, I think is an important one. Accounting for SAFE and SAFT agreements. We'll touch on this because it comes up a lot. How crypto assets appear on the balance sheet. This is one that's a whole rabbit hole, but I just want to touch on it and give folks a quick view into how to think about this from a technical accounting perspective. And yeah, why not one more? Bad debt management, I think, is something that folks miss period over period. So access to funds. Is this, What do you think, Nick? Is this different in a business with crypto at its core, or crypto on its books, versus a traditional business, or same thing?
It's a good one because it is a little different, right? Because in both scenarios, you probably have a small team. So this term segregation of duties, which may be unique to our world, but all that simply means is, do you have the ability to separate certain aspects, right? Does the person who actually cuts the check have a different role than the person who's feeding, hey, these are the expenses we need to pay? And the reason that control separation is important is that now there's someone to kind of check the check writer, right? To say, hey, well, this is the list of approved expenses. Why did you write more? Why did you pay this vendor that wasn't on the list? And so that creates a control for the company over flow of funds. So that's kind of the traditional sense. But again, most teams don't have a large enough finance department as we've laid out to maybe separate those controls. So it can be a little different. So in the crypto sense, it becomes, hey, have you implemented multi-signature wallets to just have kind of maybe 3 signers, so that you need 2 out of 3 to actually send funds? And hopefully in that scenario, when you're trying to get signatures, you also need some kind of proof of, hey, here's why we're going to be signing and releasing some funds today. So I think that's something that, again, controls maybe is not something founders are thinking about, but you'll want to implement early, just even for your own sake and protection of wallets.
Totally. I think that's well put. Yeah. I mean, there's some businesses that are running out of MetaMask and Phantom browser wallets, right? And those are very helpful because they're quick access, easy access. But I think also thinking about tiering the level, the way you custody, the way you manage crypto assets is really important, because definitely not all of the liquid crypto for a business should be sitting right in a browser wallet. And so I think crypto folks generally know that, but I also think that convenience gets the better of them, frankly. So that's a bit of an accounting piece, but also like a security and custody piece.
It's a great point, right? And then how could a founder mitigate with that in mind is, hey, that hot wallet that we know we're using maybe to just test things out or be flowing, we're not going to keep a large balance in, because we don't want to have to put multi-sig on it. We want our team to be able to just move quick. So how do I put a control in place with that same goal in mind? Well, we're going to keep that wallet topped off at a low amount that, we're generally comfortable losing if the worst case scenario could happen.
I want to touch on SAFE and SAFT agreements and then have you chime in if I miss anything or you've got any context. So SAFE agreements, simple agreement for future equity, really born out of the Y Combinator days and a unique legal piece of paper, essentially, a few pages that essentially allows an investor to get in an angel sort of stage very easily. No equity, no lawyer transactions, just sign here. If we raise more money or we have another financing round, this SAFE holder will be converted to an actual equity, a shareholder position. And then the crypto version, because crypto has to always create something new, right? The SAFT, the simple agreement for future tokens. The same idea, except we'll give you tokens in the future, right? So it's really a pre-sale sort of mechanism. And so these are interesting. What I would say here is these are super fact dependent, and actually on SAFEs alone, the current state is actually there's no the generally accepted accounting principles, the gap on this can actually go both ways, meaning a SAFE could be recorded as a liability on your books, right? You have a liability to those SAFE buyers to give them equity in the future. It could also be argued that it should sit actually in equity. Even though a SAFE is not equity, it's maybe more akin to equity than it is to a liability. And so the technical accounting kind of needs to be done there. But depending on how much you raise on these instruments, it can be a significant impact to the financials. And so definitely reach out and let's talk about those. Very fact dependent. And SAFTs, I think really more akin to a liability. So that's the way you should think of them. Then it just is, okay, well, how long do you hold that liability, right? How often can you, is it the token generation event itself that extinguishes that liability, right? And you can recognize that revenue, or is it multiple events, right? Is it deferred over time? So again, fact dependent, kind of an interesting area, and one that can really significantly impact the balance sheet, right? Because a lot of folks are raising quite a bit of money on SAFEs and SAFT agreements. All right, let's touch on paying people in crypto. This is again another rabbit hole. So I want to, Nick, you jump in and tell me if there's other things you've seen, but I'm just going to riff a couple quick things. So first off, employees versus contractors. You have to be careful here. Crypto startups often do this borderless, talent everywhere thing, and that's cool. We use contractors here and there as well, but you have to be sure that those are truly contractors and not employees. Local tax authorities look to these things. They see people being paid as contractors and they want to collect payroll taxes, right? So they'd rather have that person be an employee with your business, and therefore they're collecting payroll taxes. Contractors, again, fine, but you have a 1099 requirement, right? You have to fill a tax form to show the wages that you paid to a contractor. And there's a lot of good platforms that help with this. Deal is one of them that, is crypto and non-crypto, helps you, contract with people in a compliant way. And if people are employees and they are truly employees, right, they need, there's a payroll tax aspect, the W-2 requirements, and a number of other things that come up. So definitely recommend getting onto a payroll provider platform, pretty quick. That is one app that I would say, yes, you get that going early.
And they're going to help you with those check boxes, because it's not just, you don't get to just choose, I'm calling this person a contractor or employee, right? There's qualitative factors of, hey, if this is all this person is doing full time, then they probably are an employee, even though you want to pay them as a 1099. So that's kind of, I think, the larger point you're getting at there is, hey, you don't want to not being paying attention to that, because if the IRS, someone comes and takes a look and determines that that person should have been an employee, now you've got back payroll taxes that are going to be owed and could bring penalties and interest and additional costs you weren't budgeting for.
Yep. The next one is paying people in crypto. I think, this is something that, we want to incentivize employees. We want to incentivize participation in our business and people to be committed, right? Generally speaking, and tokens provide a very interesting way to do that. There's certainly a lever that a lot of people want to pull. Employees are interested in them. Oftentimes there's big upside, right? So this might be something you want to do, but I think you should do it knowledgeably when you start to think about paying in crypto, right? So you can pay for, a contractor's wages in crypto. Okay, that's pretty straightforward, just different payment currency you're using. Of course, there's a tracking aspect that comes with that as well. And every time you do that, you're potentially, again, in a partnership, having a capital gain or loss event that needs to be tracked. In a C Corp or an Inc., you're having a potential income event. And so you need to think about that tax basis when you're paying people in crypto. The other thing that has become popular, right, is fringe benefits, right? Paying fringe benefits in tokens, bonuses, essentially. There's a whole bunch of compliance requirements that come with paying bonuses in that way. And one of them is a tax withholding requirement. So not only do you have a tax impact to your own financials, gain or loss, now you also have a withholding requirement, which is roughly 22%, I think, for 20%, I think, for 24, and goes up a little bit in 25. Anyway, that's a significant amount of tax. The other thing I got to tell co-founders here is prepare for people to be disappointed and annoying. They're going to bug you when they like, wait a second, I saw this on my payroll statement, but I'm tracking my own crypto taxes. And I found out at the end of the year through TurboTax, I actually owe $40K in taxes, or, some pretty significant lump sum of cash that they're going to have to come out of pocket because of the receipt of that bonus. And so, yeah, we've helped companies with this too. Like I just did one last week for a pretty large token project and helped their employees. There's like 30 folks on the call, and we just went through, okay, like what are all the implications of accepting these bonuses? Like how should you track them? What's the implication of, sort of receiving payment at $1, in January, and in December around tax time the next year, holding a token that's worth half of that or 25% of that. That's like the disaster scenario. So there's a whole bunch there, but definitely a lot of things to consider when paying in crypto. Sounds good. Lots of things come with it.
Yeah, it's fair to say that there's, you want to move fast, but there are certain times where, hey, it's okay to pause. Hopefully you have that trusted advisor, someone like us or someone else in your network that you can go ahead and pick up the phone and say, all right, here's what I want to do. What am I not seeing down the road, or what do I need to consider now so that this is a deal that works for everyone and is the best interest of the business?
Awesome. So yeah, I think we can wrap it up. I mean, I would say at this point, it's, just reminders to think about building this solid financial foundation, this best practices foundation. It will serve you. If your business is successful, you're going to need to lean on this piece of the business. You're going to need to lean on your financial reporting at some point. And so then, also don't avoid the key obligations. Think about them. Think about how they impact your cash flow, your overall operations. When in doubt, definitely reach out, because these are pitfalls and potential problems that can accumulate pretty quickly. And just kind of dealing with challenges as they come, I've seen is always better than kind of having to deal with them all at once in a cleanup process that can be pretty frustrating. So this is something we specialize in. I hope you found the content valuable today. Hopefully you took some things away from it. And thanks for joining us on another TNF Takes.
Thanks, Noah.
Thanks for being with me, Nick.